What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Double Trouble. I got Lucas and Ryan. How you doing today? Let's start with you, Lucas. How you doing today?
Doing well, man. Happy to be here.
Awesome. And Ryan, how about you?
Yeah, doing great. Good to be here. Thanks for having us.
Sweet, my pleasure. And I got some extra special great news for the two of you. Today, we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, it's because this is a chance encounter where I interview commercial real estate syndicators, buyers, sellers, investors, sponsors, all that kind of stuff. And you may ask yourself, why would you do that? Well, the answer is, if you've ever heard of an off-market deal, they're sometimes called private deals, they're sometimes called 506B syndications, well, then you should also know that the SEC requires that you have a documented prior substantive relationship, or else the SEC will get ants in its pants. We don't want that. That's bad. And so we have people on here to talk about their level of sophistication, appetite for risk, core competencies that they want to contribute to the deal. And the whole point for you is to make sure that you can learn how to effectively communicate on the subject of commercial real estate. Because if you're going to make this business your business, your communication skills are going to make or break the difference. But Ryan, before we get too deep into real estate, do you want to say a thing or two about yourself before we give Lucas a similar chance?
Yeah, we have a pretty similar story, I think, but I guess I'll take it. So I'm Ryan. I've been in real estate for about 3 years now. Started small in my own backyard with triplexes and duplexes. Realized I didn't want to be a landlord because it's terrible. And so we started syndicating deals. Got family and friends involved to help them get cash flow, equity growth, tax benefits. And now we're scaling up and getting accredited and non-accredited investors to join our bigger stuff now. So yeah, that's kind of where we're at.
Awesome. Lucas, how about you?
Yeah, going off what Ryan said, so we've been in business together for north of 3 years now. Ryan and I have known each other our whole lives, so a lot of times when I talk to investors, it's very important to tell them invest with somebody you know, like, and trust. So you have some knowledge of knowing that Ryan and I aren't people who have limited knowledge on each other, right? We've gone back for decades, so we've made a pretty trustworthy team together.
Sweet. I love it. So the first segment that we usually do in these chance encounters is the 5 distinct motivations. But before I do that, I got to say, but wait, check your 8. Hey guys, I don't know how technologically inclined you are, but maybe if you can see through the camera and down there, there might be this hideous subscribe button in the user's device that they really should. It's okay. It's a stupid joke, but anyway, the 5 distinct motivations. I've spoken to hundreds and hundreds of different investors and syndicators and whatnot, and we're all people. We all have our own unique why, our own backgrounds, our own stories. But I found that not only did all of those different unique whys fit pretty neatly into these 5 categories, but it's super important to know what somebody's motivations are in this business in particular, because after all, the deals take months to close, they take years to go full cycle. You need to know what's going to keep this person going day after day, week after week, year after year. And those 5 motivations I found are, the first one is preservation of purchasing power. What on earth is that? Well, some people, they already have a portfolio of assets, and instead of a job, the proceeds from ownership are enough to pay for all their bills and make ends meet. So why would somebody who doesn't have to work want to make another commercial real estate acquisition, right? Well, there are a couple circumstances. One is if inflation is rearing its ugly head, then that's going to eat away from the purchasing power of the cash flow, so it's going to be time to make another acquisition. The other time is if the property is under distress stress because of lack of funds or high vacancy rate, or if there's an asset crash, or say like, I don't know, interest rates doubled or tripled in 2022 and 23, that would probably be a big reason for that. But those are why some people need to make their next acquisition. But me personally, I'm not to that point yet. What I'm up to, I'm more on the active side, but because I came from the CRM industry, from tech, high wage earner, high salary earner, one of the things that really jumped out to me is, how do you pivot where you're getting rewarded in the form of deployed capital, aka equity, instead of in cash, and then giving half of it to the government? And that came to my mind because in 2014 I started doing all those CRM IT funnels and all that kind of stuff for a firm in Ohio where they were doing 10 single family house transactions every single month. So I was watching as my boss was raking in the dough, and there I was working remotely and going like, well, how do I make that happen for myself? So that is that's my biggest motivation of the bunch. But some people, they want to take control of their schedules, especially youngsters in general. Like, the idea of trading time for wealth is a little too subtle for a lot of them. So what they want to do is they want to work fewer months per year, or maybe hustle like crazy right now and retire early. And that's basically fast tracking retirement or something like that. And a lot of the people who choose this reason, they think that everybody actually has this reason, and they're actually, just kind of like putting it below the surface. But I assure you, that's not actually true. For example, some people are just plain fueled by ambition. They want to buy their entire hometown. They are going after that generational wealth. They want to make sure that their great-grandchildren never have to hold a day job, and that's why they're hustling and making their acquisitions. And before people just go ahead and vilify that, hey, you need somebody who's going to hustle into their 90s if you're going to take really good care of these properties. So these people are really, really great to have on a GP team. Now, the other ones that are similarly motivated, but it's not so much on their own family or their own name or whatever else. Some people, they've picked a sector of society. Maybe it's animals, maybe it's the environment, maybe they want to send people to space. Regardless of what it is, they figured out that if you want to make a really big impact on society, there's a financial component to that. And so that's why they are making use of equity multiples and different things like that from these commercial real estate acquisitions. So I'm going to start with Lucas this time. So of those 5 different motivations, what combination of those would you say describes you best?
Definitely the financial motivation. Understanding that the passive income aspect of real estate syndications can really power my life and doing the things that I want to do without relying on my sole W-2 income, right? So making money while I'm sleeping, having money grow for me while I'm actively working on something else is incredibly important to me. And the education aspect too of this opportunity out there for everybody, but people aren't necessarily aware of it, is really where I take pride of, educating people on the aspects of syndications.
Mm-hmm. I love it. And Ryan, what's your take?
Yeah, so it's kind of similar. So fast track retirement would be one, and then also just helping people who don't even know about it or want the benefits like without the ownership. So the whole syndication model itself. I like control over my schedule, like you mentioned. I had in the past, family members get laid off, so I've seen firsthand how things can spiral from there, and they have to get part-time jobs, kind of scramble for bills. So that's something I don't want to have to do. So right now I want to, build my portfolio, help others take control, and then, like Lucas said, not have them rely on that single income stream when, you might not have a job tomorrow. So who knows?
Mm-hmm, mm-hmm. I love that answer. It's it's not the most pleasant of truths, but it's definitely a fact. And the fact is, there are risks involved. There's risks involved with having a W-2. There's risks involved in every single type of business. Commercial real estate is no different, no big surprise. But if you've ever been involved in a 506B syndication, one of these off-market deals, then whoever the securities attorneys, the person who works with the SEC, whoever they were, they should have insisted that everybody who is an investor, who's a partner, everyone who's involved should have filled out this questionnaire that's super duper invasive. All sorts of financial questions about like how much money your net worth is, how much you've invested in this, that, the other thing. But when I was going through that questionnaire, there was one question where I felt that it didn't really give me actionable information, usable information, and it was the tolerance for risk assessment question. So I made my own one that I think does fit that bill, and it's a fill in the blanks. It is, there are many popular investment asset classes, but I think blank is too risky. So the answer can be inside real estate, it can be outside real estate. Ryan, let's start with you. What's too risky for you?
I may get some hate for this one, but I'm going to say crypto. Not a big crypto guy. A lot of my friends try to sway me into that market because of that boom. Some people made money, some people lost money. I just think it's too risky, not stable for me, so not a fan.
I love it. After all, it's straight appreciation, right? Lucas, How about you?
Yeah, I mean, I was kind of go down that same alley. I could take the cheap answer here and say NFTs, right? But we're kind of talking about the same token here.
Yeah, absolutely. And it's really funny because I try not to poison people's thoughts before the interview on that. It's like crypto is a pretty normal punching bag. But anyway, next up, one of the biggest reasons I mentioned appreciation, as in like the price increase. So you buy low, sell high. So that's a pretty basic way of flipping anything. And I get that. One thing I should emphasize to all of you in the audience is that not everybody in this industry is an underwriter. Some people are basically public relations, the pretty face, the front man, the front girl, whatever they are. And they're not really going to be digging and living and breathing these spreadsheets. So, but all the same, I want to make sure that if you are ever in contact with my guests, you know which metrics they tend to focus in on, even if they're not the underwriter. And I don't want to pretend that there's actually 14 different metrics on this next slide. And I don't want to pretend that, that they're not all important, because any underwriter worth their salt will definitely mention that they're all important. But for anybody in the audience who is listening and not watching, I'll read these all out so you can see them. The first one is cash on cash. Second one is IRR. Third one is cost per door. Obviously, that's leaning more towards a multifamily, but there are other types of real estate that go off of cost per door or units. The next one is net operating income, NOI. Then it's the going in cap rate, and really that's implying the difference between the going in cap rate versus the standard cap rates in that area. Next one is the loan interest rate. After that is the occupancy, which is the same as vacancy. It's the inverse of vacancy. Next is average income of people in the area where the property is located. The amortization period of the loan, especially if you're assuming it. Next is the market versus the in-place rents. So what's the difference between the market versus in-place rents? What's the population growth in the area where the property is located? What's the sponsor record, which means how many deals have gone full cycle? How many of them are on the go right now? Next one is waterfall, split, or exit. And that's the idea of like what's the exit plan? What's the split in equity between the limited partners and the general partners. And then the last one I have here is DSCR, which stands for debt service coverage ratio, which basically means how much of your income is going straight out the door just to pay for the loan. So I don't know who wants to take it first. I guess I went to Ryan last time. Lucas, what are your top three or something that really sing to you?
Yeah, so all 14 of these, right, are incredibly important, something that we're always looking at. As the investor relations specialist, those first two, the cash on cash and the IRR, those are the very top two most important ones for me, right? The higher the cash on cash is, that's the more money that our investors are going to get. That's the appealing point to them. And then the IRR as well, right? The more time that they're going to be able to get back, the more passive the investment is. Those are the two selling points that we always try to bring investors on. So those two top points right there are the ones that are always driving our conversations.
Sweet. And Ryan, do you have anything to add?
Yeah, well, I agree with them both of those points, but I'm the underwriter of the group. So the things I look at are going in and also exit cap rates. You want to be conservative with your exit, especially because it can really kill or enhance your returns. And if you don't have enough conservative underwriting, then your numbers are all skewed. So yeah, I would say that, and then just be focused on a lot of value add properties, the in-place rents, population growths, and the ability to really boost the profits in that property. So really, the difference between the current rents and the market rents themselves is another thing we like to look at.
I love it. I'm just eating that up like a subscribe sandwich. It's delicious. It's as delicious as it is subtle, but it's my subtle reminder that it's time to bring out the Dan Does Deals Commercial Core Competency Cube, which is sometimes upside down. It has the 6 different roles in the commercial real estate deal, and I go through it in every episode, once again, not only so that you can learn how to effectively communicate on the subject of commercial real estate deals and the anatomy of the teams that are involved, but it also means that you'll understand how my guests fit into these deals. And if you're looking at this die and going like, wow, I really wish I had a dandoesdeals.com commercial core competency cube, you'd never guess, but it's available for free at dandoesdeals.com. There's this great big photo of this. You can print it. You can click on it and print it out, save it, download it, all that kind of stuff. And like a complete dummy, I don't even ask for your email address. And that's the cardinal sin of marketing. You never, ever, ever give away your freebie without asking for some sort of contact information. But the main thing is I really want you to print this out and then get used to these terms so you can find out very quickly what somebody's going to do in these deals. And let's get started. When people first get into this, they're probably going to either be a local or they're going to be a repositioner. So let's talk about repositioners first. Repositioners have to look at a whole whack of different properties and do a whole bunch of paperwork before a deal gets going. And I call them repositioners because they're trying to figure out how are they going to change the property so they can find more upside. Now, of course, one of the reasons why they have to do all this paperwork, they have to figure out things like, hey, is this property even making the amount of money that the broker / seller claims it is? Because, okay. But repositioners have a few different ways to find that upside. Some of them are more intuitive than the others. One of the least intuitive ones is they all have a vast financier relations network. In other words, they deal with a bunch of people who only deal with paper and money and the people who run the deal. They don't deal with tenants or anything like that. But anybody who is a financier, strictly, they can't be a GP on the deal. They can't be one of the real decision makers in how the deal works. But the reason why these repositioners have to have this vast network of financiers is because if you can secure a more advantageous loan, or if you can generate enough equity among your financier groups, then that means it goes straight to the profitability of the building. It's cheaper money, so that way it's going to make more money. But the next place the repositioner is going to look is a lot more intuitive. They're going to look to operations and say, we got to get those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and collecting rent and doing maintenance and mowing lawns, different things like that. And if you're like me and you are focusing on 100 units or more, so you get the economy as a scale, frequently you're going to outsource property management to a third-party company. And so the question would be, well, if you're like me, I don't know if you know this about me, but I'm from the internet. Okay, so I have to have some things that I can do remotely, and those are, one is the automation and all the tech funnels, web access, and also our applications, web-based applications, and then of course also anything to do with automation of those different materials are important. But even if you are outsourcing to a property management, a third-party property management company, one thing that I bring to the table for my GP team is marketing chops. And if you understand that the enemy in this industry is vacancy, then somebody on the GP team needs to have some serious marketing chops in case that vacancy rate gets out of control and the property managers can't do anything about it. So that's where I fit in. But of course, there's only so much you can do with operations. So the next place the repositioner is going to look is to get a contractor team in to do a value add, to basically make the units nicer, make the property nicer so that the next residents will be more than happy to pay more in rent than the previous ones. And so they've discovered that upside. But if only it were that simple. You can spend endless amounts of money on contractors. You could go ahead and gold plate the toilets, but it's not going to give you a return on investment. So somebody's got to keep an eye on those contractors, making sure that they're using the appropriate materials, make sure that they're not dragging their heels on the schedule, moonlighting at other little gigs while they're busy taking care of your CapEx budget that's millions of dollars. So how do you counteract that? Once again, I'm from the internet. That means I need locals. I need boots on the ground. I need somebody who can be there in an hour or two because I categorically will not be that guy. I'd be stuck at an airport in an hour or two, so I need to rely on somebody else who lives nearby to make that happen. But when the repositioner has assembled this team, they've got this ideal property in time. Let's say you're the repositioner, okay? So let's say you're an engineer or an attorney or a physician, something like that. You get the idea in your head, hey, there's this really nice 350 unit apartment complex down the street. If my friends and I put in 100K each, 250K each, whatever it is, I bet you we could get that down payment and we could take the place over. Well, when you get all excited and you turn around to the financiers and say, hey, we're going to buy this place. It's tens of millions of dollars. You have, I don't know, tens of millions of dollars. You want to rent this? Well, the financier is going to have one other question that I haven't alluded to. And if you're in a mentorship program or working with gurus, I'd pay real close attention to this next part because they really tend to gloss over this one. The financiers are going to say, who's the sponsor? Who's the KP? What's that all about? If you want to be eligible for a commercial loan, the banks and lenders are going to insist that somebody in the fold already owns a similar asset. So there will be no taking over of 350 unit apartment complexes with a commercial loan unless somebody in the fold already owns a 350 unit apartment complex. That's who the sponsor is, what the KP does. The other thing that they tend to bring along is a bigger balance sheet, because among the ownership team, you need a balance sheet of at least the amount of the loan, and you need a certain amount of liquidity. But if you got all those pieces, you got yourself a commercial real estate deal. So, Ryan, you already mentioned that you focus on the underwriting, which is a very strictly repositioner type of role. And then, of course, if you're doing any sort of financier relations, you have to have some sort of asset management. But Ryan, what boxes do you check? We'll start with you.
Yeah, you kind of just nailed it on the head. So I do a lot of our analysis and underwriting. My background is finance and economics, so I'm a spreadsheet guy. And then also I focus on the investor relations side too. So, getting equity and investors that come into our deals. So yeah, those are kind of my two main roles. I try to vet these deals, like I said, as much as possible because I have the underwriting background, and then also help with the financing side too.
Awesome. And Lucas, you're on financier relations. Do you have like other parts like maybe like local or anything like that?
Yeah, so we focus on various emerging markets, but one of them is our own backyard too. So we can stand as the local team members that can be boots on the ground and hands on deck when needed. But for the most part, we're more of the repositioner, kind of like Captain America, right? I like to take the team and get it together, right? I'll find the sponsors and find the locals, right? So that's also kind of a characteristic that TR Capital brings.
I love it. So sort of like a COO sort of role by the sounds of it. That's good stuff. So that brings me to the next question, which is the buy box. And when real estate people are talking to each other and they say, hey, what's your buy box? What's your ideal property? That sort of thing. We're asking for three main things. The first one's geography. Where is it? We're going to need to know which state. We're going to need to know which county. We're probably even going to need to know which neighborhood. Okay, so the location is absolutely important in that way before you call it ideal. The second one's size, and most of my guests on this show are in multifamily, which is apartment complex investing. And when it comes to apartment complex, the way that you define size is by the number of apartment units. And the reason why it's important for different syndicators and investors, people in our circle, different players in the commercial real estate field, we need to know that size, because the type of group that will take over 10 unit apartment complexes versus 150 or 350 unit apartment complexes, they look fundamentally different. So that size definitely matters. But the third one, I call it desirability. Most people call it class. I don't like the word class just because it's two different things, okay? And the first one is condition, the second one is area. When you're talking about the condition of a building, we're talking how old is it, how beat up is it, how up to date is it, and like structurally sound, whatnot. Then there's also luxuries and amenities, like does it have like a gym, places that residents actually want to spend time in, and so they'll perceive it as a greater amount of value. That's still part of the condition. But when we're talking about area, Because we're talking about multifamily, the school districts where the property is located are going to matter. The crime rate for any type of real estate is absolutely going to matter. And then the third one, it brings back the location saying that brokers love to say. I don't like that because I don't think it gives you very usable information, because what they actually mean is traffic, traffic, traffic. If a gazillion people pass by a certain place every single day, it's going to be more desirable than somewhere else, so that's going to add to its value. But both that area that I was talking about and the condition, they're both ranked the same way as in grade school, where you have A plus at the top, and then A, and then A minus, and then B plus, and so on. So I guess you guys can choose for yourself this time. What's easier to say yes to and more difficult to say no to?
Want to take it, Lucas?
Yeah, so we love 50 to 450. So we're very broad, but we don't like to get too small and we don't like to get too big. 40 to 50 to 450 units is really our standard buy box. Geography, we do our own backyard. We're from Massachusetts, so we like Massachusetts and then even New England in general, right? Massachusetts, New Hampshire, Vermont, Maine. Those are really our buy boxes, and then we target the Carolinas as well, both north and south. Really strong emerging markets where we're able to kind of tap into that and spread risk across those different properties. So I would say buy box is 50 to 450. New England and the Carolinas really our bread and butter right there.
Mm-hmm, mm-hmm. And then as far as the rating for condition and all that kind of stuff.
Yeah, so we tend to try to go to Class B. You don't like Class B, but the newer the property is, it's usually harder for us to drive that value in, where we're really value driven. So we want to make sure that we can pump that forced appreciation to the property. So we like those properties that are 1970 and newer, right? We don't want it to be too old, but we don't need it to be built in 2008, right? We want it to be a little bit on the older side so we can put some TLC involved, have it under market so we can then put the renovations in to boost up the NOI with the rental increase. So that's really where our buy box is.
Sweet. Ryan, you have nothing to add?
Yeah, no, he kind of nailed everything. Another thing is we recently ventured into RV parks, which is we find a great asset too. That 450 unit he mentioned, that's more of the RV side. There's you can buy a lot more for a lot less. But yeah, those markets are pretty much our bread and butter, and we have partnered with some great operators in those markets specifically, and we hope to take 4, 5, 6 deals down this year with those 2 or 3 partners we have in New England and the Carolinas themselves.
All right, I love it. So let's talk people. And my favorite thing about commercial real estate is that because nobody's going to be all 6 sides of the die for any meaningful amount of time, they're going to put a team together to pull that off. It really means that everybody is so eager to give referrals, help build new teams, but at the same time, we have our own unique skill sets. So we're better suited to help some people more than others. Between my online marketing and the tech skills in general, that means that the sponsors and KPs are generally the people who I want to speak to the most, especially because of the debt fund that I'm getting involved in. That's as of January 2024. But the sponsors, they have the foundation, they have the real estate business in place where a guy like me can make a disproportionately large difference. Whereas when you're first getting started as a repositioner, you'll need these locals who can put in 80 to 120 hours a week. And that's just simply not where I'm at my most effective. I'm more effective gleaning out that really difficult to figure out 1% in your conversion rate. But you guys, if you have any 506B deals going on, make sure you don't mention them specifically, especially if you're going to be saying it in the same breath of looking for investors or financiers. But who's out there in the camera where you guys can help more than others?
Yeah, really. Right now, we're actually focusing on a lot of 506C stuff. Well, actually, both B and C. So we're focusing, friends, family referrals. But as far as the marketing side, that's kind of what we're doing, similar to what you're saying. Is for our 506C deals, we found a great, it's a great way to get in front of new accredited investors, and then build your referral list from there as well. But you have to build that credibility, right? So when you talk to them and talk to other investors, you're going to have to build your track record, the operator's track record, and really know the deal inside and out. So that underwriting background and everything that I could bring is really what helps us really analyze those properties.
Sweet, sweet. And Lucas, do you have anything to add?
Yeah, so for the 506B side, going back to something I touched on earlier of no liking and trusting, right? For these non-accredited investors who want to jump into syndications, it's really important that their values and their idea of what this investment is going to entail aligns with what we're trying to do as a syndication team, right? I like to do the education and explain to them, right? A syndication isn't like a 2020 GameStop play, right? You're not going to be rich overnight, but it's a wonderful tactic to grow wealth, right? It's a great opportunity to find financial freedom for passive income. And if that's what you're looking for, that's a great opportunity for you to jump into a deal. Non-accredited for 506B is something that we're always looking at, but obviously you have to have those prior relationships. You have to understand that the SEC is going to be investigating everybody who hops on a deal, right? So we take that opportunity to not only introduce ourselves with first-time investors, but to kind of bring them through that education of understanding the ins and outs. What's a GP? What's an LP, right? How does the payout work? That's the stuff, the fun stuff that, you know, I kind of get to see the light bulb go off in their head, and that's where we're able to take advantage of it and make everybody happy at the end of the day.
I love it. I love it. Yeah, it's like there's a thing called an equity multiple. You can multiply. Wow. Yeah. It just when that goes off, it really is something.
Yeah.
But last but not least, it's how to reach out. Me, I got this super duper distinct last name. Makes me really easy to find on the internet, especially on LinkedIn, which is where I spend most of my social media time. After all, it's where people want to talk business. It's not like Twitter or whatever, where they're just trying to be racist. But if you have your phone handy and you scan this QR code right here, that goes to the FAQs page of 506BME. It's over there. I'm sitting there pointing at the ceiling. 506BME, which is the platform where I help with the IT, maintaining the documentation of your substantive relations. And the idea being that if your laptop falls into the bathtub, that might destroy your documentation. And then when you get audited by the SEC, you'll have a problem on your hands. So that's what I offer there. And then if you hit up Amazon, my different books, including Real Estate is a Scam, is available on there. But if people want to reach out to you guys, email, social media, website, phone, what are the best ways to reach out? Who wants to talk?
I guess a good start. I spend my time on LinkedIn quite a bit too. So similar to you can find me there. Also on Facebook, we have our company pages and our personal pages there as well. Or just visit our website, which is trcapitalpartner.com. It has both our calendar links and then also a contact us page where you can provide any information, ask any questions. And like Lucas mentioned before, there's tons of educational material on there for you to go over in case you have any questions.
I love it.
Yep.
I love it. Anything to add,
And then
Lucas?
for me, just Lucas Ravanis on Facebook and LinkedIn and Instagram. There's only one of me out there, so if you search it, you'll find it. If there's two of them, let me know so I know to report them. But that's the easiest way to reach out to me.
Okay, and then Ryan, since your name is Twomey, how many of you are there?
There's
More than two?
More than two, but not many. So you should be able to find me too.
Okay, cool. That'll be really great.
Partner.
Sweet. And so the last thing, it's actually not for you guys, it's for you in the audience. I always do my public service announcement, which is if you've been watching this episode and you've been experiencing like searing pains in your eyeballs, like migraine like symptoms, I'm confident it's all because of the hideous subscribe button that's just down there, and you can get rid of it. It's free. You just click on it. And as far as the reason, full disclosure, why I want people to click on it is if enough people click on it, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, just so we're crystal clear, my videos may show up on your list of suggestions, but you can go ahead and ignore those suggestions because quite frankly, I just appreciate the fact that you spent this time with me. Just like Lucas and Ryan, this has been fantastic getting to know you a little bit better.
Yeah, thanks for having us. Appreciate it.
Awesome. My pleasure. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.